if you can see where that big drop occurs on February 4th, where that decline would have taken you out of the market based upon the criteria that you're going to get out at some point just below that previous low. In this case, that would be around 91. So based on our first part of this trade, we have gone from 78, a little below 78 to 91. So that's $13 a share, $1,300, which isn't too bad. Now the other possibility, of course, is that you might be, again, kind of more laid back, not willing to, jump so much. You could have kept your trade, or your stop rather, below this one right here in this vicinity right here, and just kind of rode with it, stayed in it at approximately 89, stayed in for the longer run. Now, let's assume that you didn't. Let's assume that you did, jump out of the market. You said that when it dropped here, that was a pretty good sign that maybe the things were changing and you were going to get out. So now you have a bit of a dilemma, because some of the background things that you know about what has gone on and what you hear about the economy and the economic news and the reports suggests that maybe this move could go still higher. Maybe it's not done, or maybe it is done and you don't want anything to do with it, or maybe it isn't and you want to get back in. So now you have a choice. If it wants to run, you don't want to stand in its way, obviously, because you don't mind taking additional profits, position that you had originally, believing that it would trend higher. So what we then have now is we have, when we go to the period of February 9th, which is about right in here, we have a situation where the market starts to move up, and it starts to move up, I would say fairly strongly when you see those white candles moving up, and you might decide then on this particular day, the high at that point was, the predicted high was 91.19, so that means you might want to buy at 93.19, the $2 higher mark that we talked about a little earlier. Now the other possibility is, of course, when you look at this previous high back here, you'll see it exceeds that high, pops above that high, and that's about 93.50. So maybe you want to go, stretch your parameters a little bit. Maybe you want to go at 93.50. In any case, whichever place you go in to get into the market, you've got to look back at where is your natural point at which you would get out. Where would you put your stop? That would be somewhere down here in the vicinity of 89. So when you look at that, it does take a few days to reach that 93.19 mark that we talked about here, or 93.50, whichever one you choose. So when it does hit that mark on this particular day, right here, where it finally gets into a long position, at that time you are able to place your stop in a little better position. You don't have to go way back to 89. If you want, you can, but that kind of would stretch the risk parameters that you set up. But you potentially could put your stop at a position, maybe like below the candle that you have here, putting it in here at 91, reduce the amount of risk that you have. In any case, as you look at it, when you look at this market that has now kind of like resumed its action and wants to go back up, you are in a position where you are now looking at a longer-term trend, and you are back in the saddle again, riding it for whatever it's worth. And how long will that last? I'm going to take a look now. We're going to shift our time frame again, and go with a custom chart here in Vantage Point. We're going to make this one, our latest date is going to be as late as we can get, which is the current date, and then we're going to shift this one to let's say about, go back here to about the 1st of April, or there. Well, let's go back about to the 1st of February. That would probably be about the best, simply because it would show you the whole movement of the trend. Okay, now we have it here. As you can see, in this particular case, we have the situation where the market, you have several different clues here that the market is giving you based upon both Vantage Point indicators and traditional analysis. The best clue that you have here that the market is in an uptrend, of course, and is sustaining an uptrend and moving higher, is that predicted moving average. It remains above the actual moving average. It's moving higher very clearly, stays on the upside, drive probably a swing trader a little bit crazy, but this is what you want. This is where you want to be as long as that market is going up and the blue line is moving up and the blue line is above the actual. You just stay in there. There's really not a lot you have to do. I mean, you want to market it so you can watch it, monitor it, so you can see if there's any situations where the market starts to turn. But you have a long period of time here where you have a kind of a nice little ranging market that behaves and takes the price on up. It's always all the way up to the tops near 106, 107 in that area. Everything looks pretty bullish. You have a situation where the predicted differences we talked about earlier, how they indicate some underlying strength, they have moved up, and then look where they're at. They stay in this position right here where they are pretty strong for the whole period. Now, they aren't necessarily gaining more excited momentum, but they are staying strong as long as they're above that zero line. So everything looks quite favorable for the move up. Obviously, in markets and trading, as you know, things have a tendency to change. In this particular case, we get to the date here, April 26th. To me, that looks like a doji top. Now, dojis aren't automatically tops. If you look back through that whole chart, you'll see a lot of dojis, a lot of potential types of things, but what follows a doji is kind of a clear indication of where the market is at. It has run up to its highs. Again, it's run up to a high that was pretty close, to where the all-time record highs were, here or so, or in 2007. So, it may be due for a turn. Your previous highs are getting reached. You have a doji, and then you have a following candle that really goes berserk by going down. And you also have the first indication that the predicted moving average blue line there has turned down. The first crack that we have really seen in the uptrend that had been established and lasted for a number of months. You'll also see on the bottom, when we look at what's going on with the predicted differences, that they have turned down. So the situation, coming into the end of April is pretty much dramatically different, a whole different atmosphere that we're facing out there. And the question now is, looking at all those kinds of things, are you going to ride it out? You're going to stay with the trend? What are you going to do at this point? We will assume that you've been in it for a while, you've seen the market go up, and we're going to assume if we looked at what the market has done, you have followed the the traditional pattern. You placed a stop below the last previous low that we had here. There aren't a lot of points at which to place any stops here based on previous lows earlier for this whole stretch, but this is a possibility right around 103. So you could put a stop there, and that's April 19th low, and you potentially could get out, or you could put a stop $2 below the predicted low on April 27th on that dramatic downturn day, and that would